Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
I really hope it captured that, Ryan. I'm Alex Collins.
On today's episode, we're going to be talking about how your assets are taxed. As Alex and I work with many people in different varieties in terms of what they look like financially, a big overarching theme around what many people don't really consider is where they're putting money today and growing those assets. They don't really consider how they're going to be taxed. And that's the point of today's episode.
It absolutely amazes me how little our industry talks about taxation, and how much it's really kind of become the thing that we talk about probably more than anything is, okay, now how does this strategy play in with taxation? What insight can we provide around the taxation of this particular strategy? So it's something that we talk about a lot. Now, we're not CPAs, we can't give tax advice. So it's insight and strategies, but
Absolutely. So, for those of you who are at home watching us on YouTube, and if you're driving, don't do what I'm about to say. Crack open a beer and sit back, and hopefully we can have a conversation around money so that you can take some actual insights and apply it to your own situation. Alex, I heard you crack yours open. What are you drinking today?
I am drinking a Black Raven Pilsner.
Love it.
And like Pilsner is not my normal beer. I'm changing it up because it's nice and hot, and I am having a chelada.
You need to do a better job of pouring, but
Yeah, I'm aware of that. It was the beer was a little bit shaken up when I got it. Or
nice.
a Suero, if I'm pronouncing that correct.
Gotcha. Well, cool. I went to Haywire Brewing, and so I got a Snohomish United Lager to drink. So cheers, sir.
Cheers.
So let's dive into today. So I'm going to share my screen here shortly. So for those of you, again, who are driving, make sure that you check out the YouTube channel because there's going to be some visual side of that.
And when you aren't driving, make sure to check out.
For any shape or... Yeah, for sure. But check out the YouTube channel and make sure you subscribe to that YouTube channel because we're doing more and more visual stuff as we think it gives a lot more information. And we're all visual people, right? So it just gives a little bit more information to understanding how this works. So without further ado, Alex, let's dive into today's episode. Let me share my screen. So what you're going to see here is a balance sheet of a typical client that we work with all the time, right? And as you can see, they've got savings, they've got some investment accounts, they've got some retirement accounts, and then they're making about $400,000 combined income, and they're saving a good amount of money, $57,000. We would urge them to save a little bit more. We try to push to that 20% mark. But as you can see, and this is what we often see, the majority of their money is going into the retirement plans at work. And today's conversation, we're going to be discussing, okay, you're building these different assets. How are they taxed, right? When you pull the income stream, when you stop working, how are they going to be taxed? And you need to consider that today. So those of you listening right now and you're not on the verge of retirement, the only reason you're saving money is so that you can turn on an income stream. You might want to take this into consideration because you're building these assets right now.
Well, maybe not the only reason, but probably the primary reason is to be able to create an income stream later on in retirement. And it's something where the earlier that we tackle this, so if we've got folks that are listening in their 20s, this is just going to make even more sense, not less. We'd encourage you to think about, okay, what age does your income, your current income, exceed what you expect your income will be in retirement? And the answer to that is actually much, much later than most people expect. We've done quite a bit of research and study on this, and what we have found is that sometime in your early to mid 50s to as late as your mid 60s is when we hit that crossover point of your current income surpassing what your income will be in retirement.
And so let's just take a look at this. Before we dive into how your assets are taxed, let's just make sure we understand how taxes work from where your income is, right? So we're going to take a look at this couple. Again, they were making $400,000 of income, and it's all W-2 income coming in the door. So the way this looks is this. You've got their marginal tax rate is 32%. And what marginal means is it's really the last, in this case, and I'm rounding up here, $6,000 that this couple makes is putting them into the 32% tax bracket. And so they're only paying 32% on that last $6,000. Okay. The first 23,850, they're getting taxed at 10%. So it's a taxes that their income gets taxed at different brackets. Marginal means the highest amount of taxes that you'll pay on the last dollars coming in the door. Your effective tax rate is if you take the total amount of taxes that you paid, in this case, $82,000, and divide it by 400, that's where you get the 20.53%. That's their effective tax bracket. Okay. And what Alex was just alluding to is, this is a couple that's in their 40s, right? The chances of them getting to the $500,000 plus level is still quite high because they might have another 15 years of work, right? And if that just goes up by inflation, they're probably going to get to that $500,000 level rather quickly.
And one of the insidious ways that the government raises taxes is by simply not changing where the tax brackets change.
Correct. So this is ordinary income tax brackets. Where you're putting your money decides on how you can maybe affect the tax brackets when you start to pull the money out in retirement. And there's 3 different buckets of money that we tend to see out there and in terms of how they're taxed. There is the fully taxable bucket, meaning when you pull the money out, that money is fully taxable and it's taxed just like you're seeing on your screen, ordinary income rates. Then there's the partially taxable bucket, meaning some of the money may get taxed.
Well, I think you're skipping may. You kind of slipped that word in there. May get taxed. So that partial, normally I would say potentially partially taxable.
Sure.
Because fortunately or unfortunately, folks oftentimes wind up finding a way to make that bucket fully taxable.
And then the last bucket is that tax-free bucket, right? So that's the money you get to pull out and you don't have to pay taxes on it. So from a color coding scheme, what you're about to see here is red would be fully taxable, yellow would be partially taxable, and green would be tax-free. So the question is, going back to this client's balance sheet, they've got $25,000 in savings, they've got $70,000 in investments, and they've got $900,000 in traditional 401k, and they've got $100,000 in Roth. So how they currently look, and this is a question we ask. So as you currently look at your balance sheet, what would your pie chart looks like from the standpoint of if you had to turn on the income stream, how much of your money is going to get taxed? And so as you can see here, we're showing that. What's in red is the fully taxable. This is the traditional 401k. And as I said, they've got $900,000 sitting there. They've got $95,000 in partially taxable money. What that is that's the $25,000 in savings and the $70,000 in the investments. And then the non-taxable money is that Roth. They had $100,000. That's what's in green. So this is the pie chart. So the next question we oftentimes ask our clients or potential clients is, of these 3 colors, which color would you rather see the most of? And of course, it's a stupid question because everyone always says, well, I'd rather see more green. And then we ask them, well, how did you come to these decisions? And again, a lot of this is just like, look, I got a job. I heard from day one, I need to start putting money in my retirement plan. So I did. They didn't consider what are the taxable implications later on. And I'm not saying that this isn't a beat up session. I'm glad that they're saving the money because without that, they wouldn't be looking like this to begin with, right? Without that automatic 100%. Savings from their paycheck, chances are they wouldn't have this much in assets to begin with.
Yeah, if they're good at saving, they might have saved it. in all likelihood, it would be less dollars than what they have right now.
Now, this is what they look like currently. Now we have to take into consideration, where are they saving money? As I've already mentioned, they were saving $47,000, that's $23,500 per person, into the fully taxable bucket. That is that traditional 401k. And they were saving $10,000 into investments. And if we fast forward this, let's just take them at the age 65, so 21 years from now, you're going to see this pie chart on the right change as I hit enter here. And you saw what happened. The green got smaller, right? The yellow grew a little bit, and the red grew even bigger. And what this looks like is, and this is with, as you can see, the rates of return, modest rates of return. Anything investment related is 6% rates of return. Okay. And so what we're looking at here is their $900,000 in their traditional 401k is now grown to $5 million. But that $5 million is fully taxable when they distribute it. This is when a lot of people have this aha moment, like, I never considered this.
And like, Ryan, let's take it one step further. By structuring things this way, we don't necessarily have a whole lot of choice and flexibility. What is required for that red slice?
Well, when they get to age 73 is the age right now, because they keep changing it. 73, that red slice, they have to start taking money from that bucket,
whether they want to or not, because the tax penalties to not doing so are tremendous.
It's called required minimum distributions. And so even if they had another asset, let's just say they had a business, and the business, they sold it, and that's what they were living off of. Well, when they turn 73, guess what? They also have to take money from this account. And as I mentioned, fully taxable, which means every dollar coming out of this is going to be taxed at ordinary income rates. By the way, we haven't gotten to Social Security, right? Which can be 85% of that can be taxable as well. So this is, the whys behind how people get to look like this, which a lot of it, we understand, we really do get it. And it's not that this is a horrible, horrible looking picture. It's just giving more information and insight to what it is they're building their financial plan to eventually turn on the income stream.
And the good news is we've saved a bunch of money. The bad news is most of it's going to wind up being taxable.
So Alex, how do we solve for this now? And there's really two ways.
Yes, there are two ways that we can do this. One, we can shift the cash flow or the dollars going into it. So Ryan, let's mess around with it just a little bit and move that $47,000 from taxable to tax-free, and let's see what that looks like. Well, that had a profound effect.
So for those of you listening, what I would make sure we're explaining to the people that aren't watching us on video here, the green, which was just a sliver prior, is now, what is that, 35%, maybe pushing 40% of the pie chart now. So right, that non-taxable asset's grown to $2.3 million now. So now it's a much more, we'll call it a diversified tax asset that they've got.
Right. And now ultimately in this situation, the client had time on their side. If the client was right before retirement, they wouldn't necessarily have the time on their side to be able to make this change. And so cash flow shifting is easier because it typically requires less effort, less work, less negatives or potential negatives that are associated with it.
And real quick, I want to bring this up because this does come up. The way we shifted it, right? Many people are thinking, okay, what's this non-taxable asset? Because they're making $400,000 a year. They may not be able to contribute to a Roth IRA, and they definitely can't put $47,000 into a Roth IRA. Well, in many major companies, you can put money into your Roth 401k. Mm-hmm. So the same dollars can go in there. $47,000 goes into the Roth 401k. And just so I'm clear, you don't lose the match. Your employer will still put the match in. They're not going to put it to the Roth side, most likely. they're going to put it on the traditional side, but you won't lose the match. So that's a common misconception. So I just wanted to put that out there.
Right. And so in this case, we had time on our side. And if there is a match, let's say that they would match, I don't know, $10,000 a person, Ryan. So go ahead and add the $20,000 back into the taxable side. And so now, that shifted it a little bit back so that there's a little bit more red, a little bit less green, a little bit less yellow. Ultimately, that's one way of doing things, is through cash flow shifting. And the more that we have time on our side, the better this works. It also just so happens that the more time that we have on our side, typically the better Roth works compared to traditional. And there's some other vehicles and structures that we can look at that get us similar taxation to Roth. The other type of shift that we can do, and Ryan, if you would go ahead and throw this back to the original 47,000 in fully taxable and zero out the Roth contribution, is we can do asset shifting. And so in this example, we could potentially take the $900,000 that's in the fully taxable bucket and shift that over to the non-taxable bucket. So take that to zero and add an extra zero on the end of the taxable. And now we wind up with an even bigger shift in the future. And so now we're predominantly green. We still have some yellow, and we've got a bit of red. But the red is much, much smaller in this compared to the other. Now, if we moved $900,000 from the fully taxable side over to the non-taxable side, that is going to have some very significant tax implications and tax consequences. We may not want to do that all in 1 year, unless we've got some really, really large deductions to go ahead and offset it. But it's the same, like the concept is still there. This is called asset shifting. And whether we do this all at once or do it over time, this calculator, it's not possible to show over time. And so we're just showing it being done all at once, even though we wouldn't necessarily recommend doing that on a regular basis.
So those are the two ways to change what your pie chart looks like from a standpoint of taxes when you turn on an income stream from your assets, right? Asset shifting, as Alex just went over, as well as cash flow shifting. These are the items that we recommend looking at specifically, and you should be partnering with a financial advisor who also partners with the CPA, right? Like those two professionals should be communicating with one another to help you build the best plan built for what you want. Because there is not a one size fits all. What I hope is not coming across is we actually are not in the camp of everything should be green. We want to make sure that we have diversification is the biggest piece. Because imagine, let me go back to if we did 47,000 in Roth, what this looks like is from an income standpoint, right? We have a total of $6 million. Of the 6 million, 2.3 is tax free. Alex, if we go back to the tax chart, right? If this client needs $400,000 of total income, or they want $400,000 of total income, and now we've got some tax diversification,
Let's say that half of it is tax free.
Right. If half of it's tax free, this changes it dramatically. Their effective tax rate goes down to 8.46%. It more than cuts it. What is that? 60%?
It saves about $50,000 in taxes.
Yeah. They were paying $82,000. Now they're paying $33,000. So it has a huge effect on turning on the income stream, right? Because over here, 400,000 minus 33. So that means they're netting, and I'm going to round up here or round down. That's 370. Whereas in scenario one, 400,000, if all of it's taxable, now they're only getting 320. So that's $50,000 more income that they get to spend and enjoy for life.
Hey, cash flow, not income.
Sorry.
Hey,
Alex, the analytic, likes to be really picky.
It's all about cash flow. It's all about how many dollars are in your pocket and how you get to spend it. And people are probably wondering at this point, okay, guys, this is great. How the heck do we do this? Well, stay tuned next week where we're going to walk through a little bit of like some of the strategies on how we can do this. Not all of them, but some of them.
So I hope this episode is valuable for you. Head over to beerandmoney.net, and at the top of the page is a Contact Us page. If you have any questions for this, like if you're looking at your own situation and you're like, how do I, I've got a question on X, Y, or Z, it's a great way to reach out to us and ask that question. It's also where you can see the video to today's episode. So beerandmoney.net is a great spot to do that. Definitely take a listen to our last episode. That would definitely, it's a continuation from last episode, and we're going to end this 3-part series on tax distribution strategies. We can wrap this thing up. As always, we hope this episode is valuable for you. And Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8198347.1. Expiration date July 2027.